Hi, my name's Eric, and I'll be reading Barrons magazine dated October 5th of 2024 for the Audible Local Ledger. This reading is expressly for people who are blind or print disabled. The cover story has a headline that reads, Tesla Robo-Taxi Day is a make-or-break moment for Elon Musk. Elon Musk needs to convince investors that Tesla is still more than a car company. Its stock depends on it. Tesla was once the red-hot center of car innovation, but now it feels at risk of sinking into irrelevance as just another automaker. Its coming Robotaxi Day may be Elon Musk's last chance to convince investors that Tesla still has it. The rise of Tesla was spurred by Musk's vision, and he always seemed ahead of the competition. The company was building electric vehicles when few believed they would ever catch on in the U.S. Musk also convinced investors that Tesla could be the Apple of autos, with its own ecosystem selling everything from self-driving technology to solar panels and energy storage batteries to customers, with Musk as its Steve Jobs. By 2021, it was a trillion-dollar company, a year before NVIDIA reached that milestone. But Tesla's EV lead over its competitors is narrowed, and with it, its aura of inevitability. Companies such as Ford Motor and General Motors in the U.S., Volkswagen and BMW in Europe, and BYD, NIO, Toyota Motor, and Hyundai Motor in Asia make EVs, including hybrids, an increasingly popular option Tesla has no desire to match. At the same time, all the high-tech gadgets and features that Tesla offers, including the cool screen, the app, and the epic acceleration, are available in cars ranging from Mercedes-Benz Group's luxury Mercedes EQE to the more affordable Chevy Equinox. Even innovation in self-driving, which has been the North Star for Tesla investors, seems to be coming from Waymo, the Alphabet unit. Tesla stock languishes some 40% below its record high as EV growth decelerates around the globe. Tesla, though, still commands a premium valuation at almost 90 times earnings estimates for the next 12 months, putting it among high-flying tech companies like Palantir Technologies and Snowflake. Whether the stock will regain its previous highs or sink back to its lows is now up to Musk, as he prepares to stand before investors at Tesla's Robotaxi Day in Hollywood, California on October 10th. Ostensibly an event to highlight the self-driving technology that would allow the company to compete with the likes of Waymo and GM's Cruise, Musk needs to convince investors that Tesla remains a hotbed of innovation and still deserves to be thought of as a tech company like Apple, Amazon, or Alphabet. The outcome could determine whether Tesla regains its place among the Magnificent Seven or is relegated to fighting it out with dozens of automakers for EV market share. Few industry events have been as widely anticipated as Tesla's Robotaxi Day, says Wolf Research analyst Emmanuel Rosner. The opportunity's massive. They still have a lot to prove. Musk's choice of robotaxis seemed odd when he first announced it in April. His first self-driving prediction came in late 2016, when he said that Tesla expects to take a cross-country autonomous road trip in 2017. He's predicted that true self-driving is just a year away every year since. Even Musk admits he tends to be overly optimistic. But self-driving is getting closer to a reality, at least for Tesla's competitors. Waymo is completing more than 100,000 rides a week without a driver. Uber is adding self-driving cabs from Cruise while partnering with Waymo and investing in NVIDIA-backed automated driving startup Wayve. Tesla, for its part, has taken its own path, rolling out incremental improvements to its driver assistance product called Full Self-Driving. Musk has hinted that other automakers are interested in Tesla's technology, but no concrete deals have emerged. Musk will have some convincing to do on October 10th. While competitors use laser-based radar, ultrasound, and optical cameras for their self-driving vehicles, Musk believes all that's needed are optical cameras and a neural network. That is, eyes, and a big brain, with Tesla's artificial intelligence computers acting as driving instructors, building computer code as they receive data from Tesla vehicles on the road. The Waymo approach has achieved a roughly 75% reduction in crash-causing injuries when compared with human drivers, according to the company. With over 22 million driverless miles driven, Waymo has experienced 46 fewer accidents than would be expected by a human driver in San Francisco and Phoenix. Tesla doesn't distribute comparable safety statistics, but users of the company's highest-level driver assistance product can submit data to Performance Aggregator. FSD Tracker is one tool that lets investors see performance data by each version of Tesla's FSD software. That data shows FSD completes roughly 90% of drives by itself, with drivers needing to take over every 100 miles or so. Not close to acceptable, says Green Hills software founder Dan O'Dowd, a longtime critic of Tesla's approach to self-driving. O'Dowd says that performance is equivalent to rear-ending another driver once a month, and believes Tesla isn't close to solving autonomous driving. I like to think of the autonomous vehicle race as the Tour de France, and Elon is on a tricycle, he adds. Tesla provides safety statistics that indicate that using Tesla's driver assistance technology lowers accident rates materially. The technology, however, requires drivers to pay attention 100% of the time. Still, investors can expect Musk to exude confidence that the technology will work, even if it's different from that used by his competitors. I recommend anyone who doesn't believe that Tesla will solve vehicle autonomy should not hold Tesla stock, he said in July. It wouldn't be a surprise to hear Musk say something similar on this Thursday. Tesla's technology might be different from most U.S. competitors with multiple sensors, but it isn't all that unusual. Deutsche Bank analyst Edison Yu notes that in China, where competition's fierce and updates come fast, most companies are adopting the same approach as Tesla. I don't know the final answers, but a lot of people with a lot of money are all moving in that direction, he says. To some extent, the debate over approach misses the point. No car maker gets to declare victory by turning an unsupervised self-driving technology in all of its cars. In California, where Waymo operates, there's an application to deploy self-driving cars. While it's only 3 pages, Section 3 of the application requires applicants to prove the cars can drive themselves safely. The DMV thoroughly reviews all information for accuracy before issuing a permit to operate an AV, autonomous vehicle, on California public roads, says a spokesperson for the California Department of Motor Vehicles. Only 3 entities have a license to deploy driverless cars in California: Waymo, startup Nuro, and Mercedes-Benz, which has a product allowing drivers to stop paying attention on freeways and highways at speeds under 40 miles an hour in ideal driving conditions. Last year, Cruise had its license suspended after an accident. Tesla, along with Mobilize Global, Nissan Motor, and even NVIDIA, have permits to test self-driving cars in the state. Expectations are still sky high. Coming into the week, Tesla stock had gained almost 50% since Musk announced Tesla's Robotaxi Day on April 5th, helping to arrest a slide that had seen shares slump some 35% to start the year. Meeting expectations will require, at minimum, a physical robotaxi, a plan to launch unsupervised service no later than 2026, and an explanation of how Tesla will make money from its self-driving cabs. The excitement isn't only about the robotaxi. A growing number of observers expect Musk to also have news on a low-price car known as the Model 2. A lower-priced Tesla, starting with a price under $30,000, would help kickstart sales again while expanding the company's addressable market. I think we'll see the Model 2, Baird analyst Ben Callow says. The need is pressing. Through August, Tesla's U.S. sales were down almost 10% year over year, while overall EV sales grew just 7%, according to Ward's Automotive. That compares with 25% for Tesla and 46% for the industry in 2023. Wall Street sees Tesla delivering about 1.8 million cars in 2024, essentially flat with 2023 and down from the analyst predictions of 2.3 million cars a year ago. Without enough affordable models or charging infrastructure, hybrids have stolen some of Tesla's shine. Through August, U.S. sales of plug-in hybrid vehicles rose 18% year over year. Sales of so-called mild hybrids, cars with an electric motor and batteries that don't plug in, grew 35%. If there's a silver lining for Tesla and the industry, EVs as a percentage of new car sales are up, and sales of electrified vehicles, be they hybrid or fully electric, account for about 19% of total U.S. sales. That's up some 3 percentage points from the same period a year ago. Tesla doesn't have a solid record of delivering on high expectations at these kinds of events. For every successful presentation, the stock rose 12% in the days after the March 2016 unveiling of the Model 3, the first truly popular mass-market all-EV that people around the globe wanted to drive. Others have resulted in disappointment. Tesla stock dropped 16% in the days following Tesla's 2022 AI event, which included a working prototype of a humanoid robot. Tesla's first AI event in 2021 featured a person dancing in a robot suit. I would not be surprised, and I fully expect the stock to pull back on the event, says William Blair analyst Jed Dorsheimer, who rates Tesla stock a buy. The trend for most of Tesla's Analyst Day's big announcements is the stock runs into those as expectations rise, and then there's a disappointment. Success or failure depends largely on Musk. Bears believe he has pulled a bait and switch, distracting investors from bigger problems such as falling sales, rising competition, and declining EV profitability. Bulls believe he has signaled progress on AI-based self-driving technology that would further the narrative that Tesla is more than a car company, and that Musk, who also oversees SpaceX, xAI, and other companies, is fully engaged once again. Amid the focus on Musk and what might be revealed at Robotaxi Day, it's easy to forget that Tesla is a very large business. It has the largest network of fast charging stations and stalls in North America. The company also has a significant and growing energy storage unit, offering battery storage for homes and huge megapacks for utilities that extend the usefulness of solar and wind power generators. Tesla has hundreds of thousands of people paying $99 a month for driver assistance technology that does many tasks but doesn't turn a Tesla into a truly self-driving car, yet. It also has a burgeoning AI business with robots trained on Tesla-built computers. Musk has even hinted at building an Amazon Web Services type business using the computing power in Tesla cars and servers. Tesla also has a very expensive stock. At $240 a share, Tesla trades for 88 times 12-month forward earnings. That's a multiple higher than any of the 6 other Mag 7 companies, rather than the single digits of a U.S. automaker. A valuation like that implies that investors believe Tesla has a lot more going for it than cars. A better way to think about Tesla's worth might be as a sum of its parts, which values each business separately and then adds them together. Selling electric cars should be the most straightforward. It isn't. Street estimates vary wildly. Analysts value Tesla's car business as low as $40 billion and as high as $660 billion. The truth is likely somewhere in the middle. Tesla could sell 5 million EVs by 2030, as it adds a couple of lower-priced models and perhaps a derivation of its full-size Cybertruck pickup. Operating profit margins should be a little better than industry averages given Tesla's owned and operated supercharging network and driver assistant features which some people pay monthly to access. Under those circumstances, the auto business could earn roughly $5 a share in 2030. If Tesla traded at 40 times earnings, about twice the S&P 500 multiple but less than half where it currently trades, The car business would be worth some $600 billion by the end of the decade. That's about 2 times the value of Toyota today for a company that would be about half the size, but is growing faster. Energy storage is the only non-automotive business that has significant sales today, and William Blair's Dorsheimer sees it generating earnings per share of $2.35 by 2028. That's up from an estimated 14 cents in 2024. If growth continues at this pace through the end of the decade, energy storage could match auto business earnings by 2030. At a similar valuation, that means another $600 billion of market value. We view Tesla Energy as the most underappreciated component of the Tesla story, Dorsheimer says. That's $1.2 trillion in business value by 2030. What's that worth today? Gary Black uses a discount rate of about 15% to value Tesla stock. That's essentially what he feels is a fair return for a stock like Tesla. Conveniently, earning 15% a year for about 5 years means cutting the future value in half to figure out what to pay for it now. So, Tesla's car and energy business are worth some $600 billion, or a little less than $200 a share. Then there are all the other bits and bobs that may or may not be significant. The robo-taxi business has the potential to be big if it pans out. RBC analyst Tom Narayan says it could be worth up to $400 billion. Uber Technologies, which is built on the premise that people will pay more than it costs to operate a car for the convenience of not having to drive, has a market value of $153 billion. That's more than GM, Ford, and Stellantis' $133 billion combined. Tesla's nascent humanoid robot business could be worth $22 a share, or $70 billion if Tesla sells 200,000 robots a year, costing $50,000 each by 2035, according to Deutsche Bank's U. It's hard to value businesses that don't exist yet. No one owns a droid yet. Still, investors have to wrestle with AI applications to understand Tesla stock. For Tesla to be one of the Mag 7, yes, something in AI has to work, says U. It's safer to focus on what's working today. Paying $200 for Tesla stock is defensible as long as the EV and energy storage businesses continue to grow. Anything above $200 a share reflects a bet on Musk. Historically, that's been a good bet. Now it's up to him to prove it still is. From the technology sector, or section, of Barrons magazine this week, the week of October 5th, Palantir stock soars to another record high by Emily Datillo. Palantir Technologies stock pushed even higher on Friday after closing at a record on Thursday. On Friday's trading, the stock climbed 2% to $40.01, a new record according to Dow Jones market data. Shares of the provider of the data analytics software provider rose 4.7% to $39.24 on Thursday. There really wasn't a ton of news to digest about the company. The most recent headline came earlier this week. Barrons reported that Chairman Peter Thiel has sold the maximum amount of stock his trading plan allowed for him to unload. According to a securities filing on Tuesday, Thiel sold 12,412,322 Palantir shares from September 27th through October 1st for $457.4 million, an average strike price of $36.85 each. The sales were executed by Thiel's Rule 10b5-1 plan and sold through Rivendell 7 LLC, his investment vehicle that now owns 34,260,451 shares of the data analytics firm. Last month, Raymond James analysts cut their rating on Palantir to market perform from outperform and removed a target of $30 for the stock price. The team remains optimistic about AI, but offered a trio of reasons for the downgrade. The stock's stellar performance this year, an already high valuation, and the sizable gains resulting from its being added to the S&P 500 in September. Others on Wall Street are skeptical of Palantir's stock surge as well. Shares now trade at a nosebleed multiple of nearly 95 times next year's earnings estimates. It's a big reason the average analyst recommendation on the stock is a hold, and the consensus price target for Palantir is $27.56 a share, according to FactSet. That is 30% below Palantir's current price. Editorial note that Paul LaMonica contributed to that article. Precious metals is our next section. You bought Costco gold bars. Now what do you do? By Sabrina Escobar. Gold has never been more expensive, but that hasn't stopped shoppers from snapping up gold bars sold by Costco wholesales. The discount chain started selling 1-ounce gold bars on its website and in stores last year. They've since gained a loyal following from casual shoppers and gold bugs alike, who are quick to snap up a bar on the rare occasion that they are in stock. The retailer also sells silver coins and most recently added platinum bars to its assortment of investment-grade metals. Gold sales grew double digits in Costco's largest quarter and were one of the biggest drivers behind the retailer's nearly 20% surge in e-commerce sales. Given their popularity, Costco has limited the number of bars it sells. Members can buy up to 5 units per transaction, and each membership is limited to 1 transaction at a time. As of Friday, a Costco gold bar retailed for $2,689.99 online, yet it was out of stock. But if you already have your Costco gold bars, the tough thing now is deciding what to do given the record-breaking bull run of the precious metal. That question weighs heavily on Angel Groff, a 42-year-old content creator and jewelry collector. Groff bought 2 bars on impulse at her local Costco last August for $1,949 each. With gold's value, also called the spot price, now hovering at $2,650, she's debating whether to keep the bars or sell them for a roughly 36% premium. Part of me wants to take advantage of buying low and then selling high, she said, but honestly, it might be better holding them long term because historically gold's always gone up. That has certainly been the case over the past year. Gold has hit about 40 record highs in the past 10 months, with the spot price rising 29% year to date, beating the S&P 500, which had a roughly 20% gain. The biggest reason for the price jump is that institutions are piling in, said Trevor Yates, an investment analyst at Global X. Central banks globally have bought gold at record clips in the past 2 years, Yates said. Hedge funds are also growing more bullish. The surge in demand from retail investors, including those who buy their gold at Costco, won't ultimately move the needle on the commodity's spot price, Yates said, but their enthusiasm certainly helps support the rally, he said. Retail investors have their own reasons for buying gold, including an overall sense of economic and geopolitical uncertainty, Yates said. Some buyers want a physical store of value in case ongoing armed conflicts boil over, while others are buying bars as a way to hedge against inflation. If you see inflation higher for longer, gold has a 2,000-year-plus track record of preserving your purchasing power, Yates said. Today's gold buyers won't be holding their bars for 2,000 years, but like Groff, they need to decide whether to sit on their hoard or take profit. To sell. Gold's dazzling prices are certainly tempting some people to sell. Vendors in New York City's bustling diamond district told Barrons that they have seen an uptick in the number of people peddling their gold wares, including some Costco gold bars. For those interested in cashing out, bricks-and-mortar gold exchanges and dealers like the ones in the Diamond District are a good place to start looking for offers, particularly if sellers need an immediate payout. Some jewelers may also buy gold. The issue with a quick trade, however, is that it isn't always profitable, particularly if someone bought the bar at a retailer like Costco, said Caesar Mayer, CEO of Crown Gold Exchange, which is a California-based gold exchange company. Retailers often price their gold products above the spot price, and most exchanges and pawn shops typically pay below spot, he said. Local vendors Barrons spoke to confirmed they'd likely offer less than market value as a way to insure themselves against any potential price drop. That means that the spread, or the difference between the asking and the bidding price, won't always work in a seller's favor. Christopher Britt, a physician from Boston, found that out the hard way when he tried to sell one of his 10 gold bars, all of which were bought at Costco earlier this year to offset some unexpected expenses. His first stop was a local precious metals dealer that offered to buy the bar at 80% of the spot value at the time. While he negotiated up to 95%, Britt eventually sold the bar to a family jeweler for 97% of the spot price. Buying retail and then trying to flip it wholesale seems like a very poor investment strategy if it is a short-term position, he said. Another option is to sell to online buyers, but this comes with its own drawbacks, Meyer said. Most of those sites require sellers to ship them the gold before making a final offer, which can be lower than the initial valuation. Sellers will also need to pay shipping and insurance to send the gold to the collection site, which could eat into profit. Or not to sell. Groff, who runs several social media accounts focused on jewelry, said she has sold gold items before, but tends to avoid gold exchanges in favor of negotiating directly with individual buyers. If she were to sell her gold bars, she'd probably go down that road. For now, she's leaning toward keeping the gold stored in a security box at her bank. Britt also views his gold bars as a long-term investment to diversify his portfolio. Indeed, buying and holding is a popular choice for many gold owners, experts say, especially if they see the asset as an emergency store of value or a way to diversify investments. But even stashing gold comes with its own considerations, Mayer said. Keeping it in a bank's safe deposit box is a good idea, he said. But people should note these aren't typically insured by the FDIC or the banks themselves. Private deposit boxes and off-site gold depositories often provide insurance on the gold bars, Mayer said, but they can be more expensive. That said, storing gold at any third-party location may not be the best option for people who want easy access to their bars in case of an emergency. Home safes solve that problem, Mayer said. He recommends safes rated TL15 or TL30, industry metrics that measure how hard it is to break into the safe. No matter where the gold eventually gets stored, Mayer notes that owners should aim to keep the bars in good condition to preserve their resale value. That means ensuring the bars stay in their plastic holding case and that any loose gold or silver coins get placed in protective plastic pouches called coin flips. It's metal on metal. You don't want them scratching against each other, Mayer said. Whether you sell gold now or in 10 years boils down to your investment goals, said Global X's Yates. But whatever the goal, sellers should keep one last thing in mind. Profits are subject to capital gains tax. The Internal Revenue Service considers precious metals to be collectibles. While gains made on metals held for less than a year are taxed at ordinary income rates, any long-term gains are often taxed differently and higher than gains on assets like stocks or bonds. The rate on long-term gains on gold varies depending on a seller's tax bracket, but it can be as high as 28% for people in the top tax bracket. The top rate for gains on securities is 20%. All this to say, all you bullion buffs would do well to remember that all that glitters isn't always gold. Our next headline is from the estate planning section of Barrons magazine for October 5th. A spouse's death brings a financial jolt. How to prepare, by Debbie Carlson. Nancy Tengler always handled her family's finances, a natural extension of her job as CEO of Laffer Tengler Investments. But she wasn't prepared for the financial upheaval caused by the death of her husband 7 years ago. Tengler's husband has been fighting to recover from an extended illness, so they hadn't taken steps to organize their assets for tax efficiency if he died. It never occurred to me that I'd go up in a higher income tax bracket as a single filer, says Tengler, who's 66 years old. When a spouse dies, money's often the furthest thing from a surviving spouse's mind. For widowers and widows, their financial picture may dim as one Social Security payment ceases and they're pushed into a higher tax bracket as a single filer. There are financial moves widows and widowers can take within a year after the spouse dies to protect their future financial position. A world turned upside down. Couples receiving Social Security income will see it reduced when a spouse dies, and the survivor receives only the higher of the two benefits. Samantha Garcia, Senior Wealth Advisor at Halbert Hargrove, says there's a one-time death payment for a spouse of $255, but the agency may also claw back the last month of benefit, often offsetting the additional payment. The surviving spouse generally can still use the higher married couple filing jointly tax brackets for the next tax year. Unless the surviving spouse meets qualifications for widow or widower status, he or she will file a single tax return the following year, with its much lower standard deductions and reduced threshold for tax brackets. For example, a single person using the $14,600 standard deduction will hit the 22% bracket if his or her taxable income reaches $61,751, while a married couple using the $29,200 standard deduction can make up to $123,499 before hitting that 22% bracket. Healthcare costs may rise as Medicare premiums are tied to income. Couples pay the standard premium of $174.70 up to income of $206,000, but single people pay it only to $103,000. Any incomes above those levels are subject to steep premium bumps. For working-age couples, death may mean loss of access to an employer-provided health plan, and the surviving spouse may need to access COBRA or buy insurance on the open market, says Hollis Hardiman, certified divorce financial analyst and partner at Merit Financial Advisors. Tengler lost her husband when she was about 59, which is the average age of widowhood for women, according to the U.S. Census Bureau. The smaller costs and loss of discounts can add up as well. Hardiman says veterans' benefits, such as reduced license plate fees, property tax reductions, or health care benefits will end if the deceased spouse was a veteran. Home maintenance costs may rise, especially if the surviving spouse now needs to pay for services such as lawn care or snow removal. Couples' discounts for insurance premiums and loyalty programs cease as well. Garcia says while some costs may drop, they may not be cut in half. For example, cell phone plans may be cheaper with one less line, but the bill could still be 2/3 of what it was. Prepare for the worst. Not all deaths are foreseeable, so it is worth it for couples to set aside time every 3 to 5 years to review beneficiaries, trusts, and making sure assets are properly titled. These are all actions that Tengler had to take following her husband's death, tasks that took longer to accomplish on her own. In the fog of grief that first year, she says she failed to make key financial moves. She missed out on completing Roth conversions of individual retirement accounts. Owners of pre-tax accounts can move their assets to an after-tax Roth account, and the amount converted is taxed as ordinary income. It makes sense to complete a Roth conversion while the surviving spouse can take advantage of the higher standard deduction and more generous tax brackets when filing as a married couple. And she didn't sell their primary home to take advantage of their joint $500,000 capital gains exemption as a couple. When she did sell it, 4 years later, she got only half as much of the profits protected from capital gains taxes. Losing this $250,000 exemption was a real gut punch, she says. Garcia says she advises clients not to make rash decisions, even if they seem to make sense financially. But there are some important steps that must be taken before death or in the calendar year after death. Hardiman worked with a couple where the wife got pancreatic cancer. Before she died, Hardiman moved stocks with large capital gains out of a joint account into one solely in the wife's name. When the husband inherited the stocks after her death, he received the equities at current value and will pay no taxes on the gains. Garcia used accumulated capital losses for a couple to offset gains in a trust brokerage account after the husband died earlier this year. Normally, capital losses expire when the investor dies, but spouses have the right to use those losses the same calendar year. As Garcia redid the revocable trust, she was able to sell highly appreciated assets and take advantage of the losses. Garcia suggests high net worth surviving spouses file a 706 estate tax return, even if they don't owe estate taxes. The estate can elect to transfer to the widow or widower any deceased spousal unused exclusions, preserving the spouse's exemption for themselves. Doing so could eliminate estate taxes for your kids when they inherit all of it, she says. The next story is a feature story from Barrons. Social Security shortfall could cost millennial couple nearly $1 million, by Elizabeth O'Brien. A millennial couple could lose more than $908,000 in lifetime Social Security benefits if Congress fails to shore up the program's trust fund. The estimate comes from a new report by HealthView Services, a retirement healthcare data analytics firm. The report quantifies both the impact of proposals to reform Social Security and the failure of Congress to implement a fix before the projected depletion of the retirement trust fund in 2033. If lawmakers don't act by then, the trust fund will run out of money, and incoming payroll taxes and other revenue will only be able to fund an estimated 79% of scheduled benefits. Put another way, Social Security recipients could face an automatic 21% benefit cut in 2033, one that will total $908,482 in future dollars for a heterosexual couple where the man is 40 today and the woman is 38, according to one scenario in HealthView's projections, which draw on modeling by the Society of Actuaries. Most experts predict that Congress will act to shore up Social Security, but a fix will involve politically unpopular moves like raising taxes and or cutting benefits for younger generations, making it likely that lawmakers will wait until the deadline gets closer to pass legislation to restore Social Security to solvency. Under current law, Social Security isn't allowed to borrow to finance its operations, so it's not a matter of simply printing money to cover the program's shortfall. The reality is, no matter how you slice it, someone's income will be reduced today, in retirement, or both, says Ron Mastrogiovanni, CEO of HealthView Services. Even under a worst-case scenario, Social Security isn't going away. As long as people continue to work and pay payroll taxes, money will flow into the program. But some advisors say workers should consider scenarios in which their full benefits aren't paid out. A conservative approach, for example, would be to plan for a 21% benefit cut to Social Security. Some clients insist that advisors not include Social Security in their retirement income projections. If you budget for zero Social Security income, you'll have to save much more to compensate, potentially undercutting your lifestyle today. If you budget for a 21% reduction, the additional amount you have to save is more modest. It's also possible to model how much more you might need to save and invest. Consider the couple who would lose more than $908,000 in a 21% cut to benefits. HealthView's hypothetical couple makes a combined $175,000 today, with a husband earning $115,000 and the wife earning $60,000. With that kind of income, the couple would need to invest a combined $114,930 today, at ages 40 and 38 respectively, or $244 per biweekly pay period, assuming a 6% return in pre-retirement and a 5% return in retirement, according to calculations HealthView ran for Barrons. Their projected $908,482 in lost income is in future dollars, and it includes an annual 2.4% cost of living adjustment to Social Security. The projections assume the couple retires and claims Social Security when the husband turns 65 and the wife turns 63. They also assume the man dies at 86 and woman dies at 90. Because spousal and survivor benefits are included in the calculation, you can't divide HealthView's projections by 2 to get the impact on a single person. How might Congress avoid this scenario? A popular partial fix would be to increase the full retirement age, which is the age at which you can claim 100% of your earned benefit. But lifting it gradually by 1 year from the current 67 for everyone born in 1960 and later to 68 would still cost HealthView's millennial couple $324,667 in lifetime benefits. Another frequently discussed solution is eliminating the cap on taxable earnings for Social Security. For 2024, earnings above the $168,600 cap aren't subject to the 6.2% payroll tax that employees pay. Employers pay an additional 6.2%, while self-employed individuals pay the full 12.4%. Under the current system, anything above that amount isn't taxed and doesn't count toward affected workers' future benefits. Eliminating the cap and providing no additional benefits in return would eliminate 70% of the shortfall. It would have no impact on those whose incomes fall below the cap, but higher earners would pay more for the same future benefits. From the retirement section of Barrons magazine, unhappy with your Medicare plan? You can make a change, by Elizabeth O'Brien. If you aren't happy with your Medicare plan, this is the time to consider a change. Medicare's annual open enrollment period starts October 15th, and next year we'll see an unusual number of changes, both to Medicare Advantage plans and to traditional Medicare. Even if you like your plan, it's important to review adjustments coming down the pike. If you wait until next year and discover something you don't like, it'll be too late in some cases to make a switch. Open enrollment runs from October 15th through December 7th. It's an opportunity for the country's 67 million Medicare recipients to pick a new Medicare Part D drug plan, a new Advantage plan, or switch from traditional Medicare into Advantage, or vice versa. Changes made during this period will go into effect January 1st of 2025. By now, Medicare recipients should have received their annual notice of change from their insurer, detailing changes to their coverage for 2025. You might also have to go online to find your plan's formulary or list of covered drugs. One of the biggest developments for 2025 is a new $2,000 cap on out-of-pocket drug costs. It applies to drug coverage through both standalone Part D and Advantage plans, and it'll be a huge boon to the estimated 1 to 1.5 million beneficiaries with medication costs that exceed that amount, and those who may have a serious new diagnosis or expensive prescription in the future. Medicare Advantage is also due for changes as insurers get squeezed on costs. Enrollees are likely to see changes in deductibles, co-pays, and ancillary benefits. Some Advantage plans will exit the market altogether for 2025. It's the most important open enrollment period in Medicare's 59-year history, says Melinda Cogill, co-founder of 65 Incorporated, an independent Medicare consultancy in Milwaukee. Here's what to know. Medicare Advantage. Medicare Advantage plans are in a bit of turmoil. Humana, one of the largest insurers, recently lost a star rating from the federal government for its largest Advantage plan. Insurers are facing higher costs. Many will push some of those higher expenses onto members for next year. That may include increasing deductibles, shifting to a co-insurance payment model from a flat co-payment, or curtailing ancillary benefits like dental and hearing coverage. Some Advantage plans are leaving the market in 2025. For example, Centene subsidiary WellCare has said it would exit the Medicare Advantage market in 6 states, and Humana announced it will stop offering Advantage plans in 13 counties, affecting around 560,000 beneficiaries, according to Becker's Payer Issues. Advantage enrollees whose plans are being eliminated must actively enroll in a new plan to stay in the program. If they don't make a choice, they'll automatically be placed in traditional Medicare for 2025 and have the chance to buy a Medigap supplement plan without going through an underwriting process. This would open up a brief window of opportunity to buy Medigap insurance. Normally, outside a narrow period when you first enroll in Medicare, beneficiaries in most states must pass medical underwriting to buy a Medigap supplemental plan. That hurdle becomes harder to clear as you develop health conditions. It's something to keep in mind even if your plan isn't leaving the market and you want to go back to traditional Medicare. One positive, the average monthly premium for all Advantage plans, which includes those with prescription drug coverage, is expected to decrease to $17 in 2025 from $18.23 in 2024. But the premium is just part of what you pay. It's important to note any changes to out-of-pocket costs like co-payments, deductibles, and co-insurance. Beyond the costs, you'll want to make sure all your doctors will still participate in your plan for next year. Some hospital systems have stopped taking Medicare Advantage, citing lower reimbursements and increased administrative hurdles. Then there's Medicare Part D. Most Advantage plans include drug coverage at no extra cost. Many people on traditional Medicare buy a standalone Part D plan for drug coverage. By one metric, costs are going down. The projected average total Part D beneficiary premium will decrease to $46.50 a month in 2025 from $53.95 a month in 2024, according to the Centers for Medicare and Medicaid Services. That said, there's plenty of variability in premium costs this year, says Juliette Kubanski, Deputy Director of the Program on Medicare Policy at KFF. She says some standalone Part D plans are increasing their monthly premiums by as much as $35, the maximum allowed by the government. The $2,000 spending cap applies in both Medicare and Advantage plans, but it only applies to covered drugs. So it's really important to make sure your plan covers the specific medications you take. For example, 68% of Part D drug plans in the 33308 zip code in Fort Lauderdale, Florida, don't cover 5 to 7 common insulins in 2024, according to an analysis by 65 Incorporated. While the study focused on that area, the findings are representative nationwide, the company says. You can input your medications into Medicare's online plan finder tool and find plans close to you that cover your drugs. Even if you're happy with what you have, it could pay, literally pay, to take a look at how it compares to other plans in your area, Kubanski says. From the economics section of Barrons this week, dated October 5th of 2024, a former Fed vice chair sizes up rates, the economy, and Powell. The subheading reads, Roger Ferguson gives the Federal Reserve high marks for making a jumbo rate cut to get ahead of any labor market weakness, by Andy Serwer. There are any number of ex-Federal Reserve officials to call on if you want the lowdown on an interest rate cut, or a hike, as the case may be. But few have the perspective of Roger Ferguson given his time at the Fed, his private sector experience, and his background. Ferguson, who's 72 years old, was vice chair of the Fed from 1999 to 2006, which included the harrowing days of September 11, 2001, when he was the only member of the Board of Governors in Washington after the attacks on New York's World Trade Center and other locations. Through the chaos and fear, Ferguson had to make key decisions. First and foremost, he sought to ensure that the U.S. banking system didn't seize up, as some at that point thought it might, resisting a call to declare a bank holiday and instead issuing a simple statement. The Federal Reserve System is open and operating. The discount window is available to meet liquidity needs. Ferguson's early life was atypical for a member of the Fed's Board of Governors. He grew up in Northeast Washington, D.C., right behind Carver Terrace, a housing project built for the city's black population when the city was overtly segregated. It was sort of a tough neighborhood, Ferguson told me. We were pretty poor. Ferguson's mother was a public elementary school teacher, and his father was employed as a civilian by the U.S. Army as a cartographer. My father grew up during the Depression, Ferguson said. The way it affected him was this fascination with how banks work, and how do you make money, and how do you avoid losing money. This thing that we call financial literacy was just what we talked about at the kitchen table. At some point, Ferguson's intellectual aptitude propelled him first to Washington's prestigious Sidwell Friends School, and then to Harvard University, where he earned an undergrad and a law degree and a doctorate in economics. Ferguson went to work as an associate at the White Shoe Davis Polk law firm, where he met two fellow first-year associates who would figure large in his life. The first was fellow Washingtonian Jerome Powell, now chair of the Fed. We used to commute to work together occasionally, said Ferguson. And the second, Annette Nazareth, whom he later married. Nazareth went on to become a commissioner at the Securities and Exchange Commission under President George Bush, that's W, then returned to Davis Polk as a partner until 2020. She now works at the firm as a senior counsel. But law would prove to be a side journey for Ferguson. He joined McKinsey, working with financial company clients before being named to the Fed's Board of Governors in 1997. Economics had been his calling, he said, following an appointment made by President Lyndon Johnson. I decided to become an economist in 1966. When Lyndon Johnson nominated Andrew Brimmer to be the first black governor of the Federal Reserve, Ferguson said. Growing up in Washington, this was front-page news. There was a lot of hoopla, and it caught my attention because I was in a house where people talked about interest rates. All of a sudden, there was this institution that set interest rates, and there was this guy who was an economist. So basically, at age 14, I knew I wanted to be an economist. 31 years later, Ferguson would follow in Brimmer's footsteps. After leaving the Fed, Ferguson served as CEO of Teachers Insurance and Annuity Association of America, or TIAA, the giant retirement and financial services provider for teachers and other professionals from 2008 to 2021. Today, he's on the board of Google parent Alphabet, working on various business projects and living in Florida. Life's been pretty good to me, so the chance to live there, while maybe not a dream come true, is pretty pleasant, he said. I spoke with Ferguson in mid-October as part of our At Barrons series at a live event in New York. The timing was fortuitous, coming just days after the Fed cut rates by 0.5 percentage point, the first rate cut since March of 2020. Here's an edited version of the conversation. Barrons: what do you think about the Fed's move last week, Roger? Ferguson: obviously it was a pivot. It was the first time they've cut rates in many years. Point number 2, it was telegraphed. Chair Powell gave a speech at Jackson Hole, Wyoming in late August and basically said it's about time to make the move. Having said that, there was some drama to cut by 50 basis points, 25 basis points. A basis point is 1/100 of a percentage point. It was sort of a close call at the end. The Fed cut by 50 basis points. I'd say they executed well. Barrons: were you surprised the Fed went with 0.5 percentage point instead of a 1/4 point cut? Ferguson: I wasn't surprised in the sense that both were on the table. I probably would have gone more for the 25 basis point cut. What I found interesting is that Chair Powell laid out the rationale I had for 25 basis points, but plugged that into a 50 basis point decision, which shows what an incredibly good communicator he is. I thought 25 basis points was fine because the economy's in very good shape. Inflation's coming down, but it isn't yet without some risk. While the rate cut is exciting in some ways, it isn't so important that they start with 25 or 50. The real issue is the pace of the cuts and where we end up. That's yet to be decided. Barrons: a cynic might say the Fed made the bigger move because it's been accused lately of being late. Does the larger rate suggest the economy is weaker than we might think? Ferguson: I don't think it suggests the economy is weaker than we might think. However, the Fed pointed out it doesn't want to see the labor market getting significantly weaker. So in the world of the Fed's dual mandate, stable prices and full employment, attention has moved somewhat to a more balanced risk, as opposed to a focus only on inflation. Now it's inflation and unemployment. On the question of being late, Powell was clear about that. He wanted to get off to a fast start, saying, we don't want to fall behind. So one might interpret that as they've learned a lesson and they don't want to be late in the future. I wouldn't criticize Fed officials for saying, gee, we've learned a lesson and we want to avoid making that kind of mistake. Presumably all of us learn from mistakes, and continue to grow and evolve. So don't criticize the central bank for doing the same thing. Barrons, what do you anticipate from Fed policy now? I expect the Fed will continue to cut rates this year. For those who are into Fed speak, their so-called dot plot shows an expectation of another couple of 25 basis point cuts this year, down a total of 1 percentage point, and then a continuation of cuts into the new year, conditioned on the economy unfolding as expected. The other thing that was interesting is when looking at where the 19 members of the Fed's policy committee thought they might end up, there was a pretty wide dispersion. They were really undecided about what we in economics would call the terminal rate. Barrons, what do you think the neutral rate of interest is? Well, Ferguson, let's start with the Fed's inflation target, which is 2%. What they don't know, and no one knows yet, is what interest rate they'll have to set to achieve and maintain that goal. The neutral rate's the interest rate that neither stimulates nor retards the growth of the economy. Chair Powell said something important. We'll know it by its works. So he isn't hanging his hat on a particular number around the so-called neutral rate. He's data-dependent and data-driven. Barrons, are you concerned about inflation? Inflation has come down, says Ferguson, depending on how one measures it, to 2.5%. There are one or two parts of the economy where inflation seems to be sticky and well above the Fed's target, particularly in the housing sector. Inflation in the general services sector is still slightly above 2%. In the goods sector, that number has come down quite significantly. Inflation is a terrible hidden tax, primarily on low and moderate income people. Mainly, folks have experienced 2% annual inflation, so when it suddenly breaks out, people are shocked. And it isn't just high inflation, but also a change in price level, and that doesn't reverse. Falling inflation is slowing down the rise in prices. It isn't bringing prices back to the level of 2 or 3 years ago. Barrons, are the Fed's tools and perhaps its mandate too blunt or broad brush to address income inequality or racial economic inequality? Ferguson, certainly its tools aren't targeted enough to deal with these major social problems. That's why we have fiscal policy and social policy. I don't think it's a good idea to burden one institution with too many responsibilities at the same time. The tools are appropriately calibrated for the jobs we've given them, which are primarily to fight inflation and keep the labor market set to full employment. The Fed's tools have evolved over time, though. It used to be simply the federal funds rate that they set at every meeting. The use of the so-called balance sheet, quantitative easing, quantitative tightening, is a new tool. Same with paying interest on reserves. Basically, banks have to leave money with the Fed, and for long periods, they got no return. Now they get a return on it. So yes, their tools are blunt, but they have been evolving. Barrons, let's look at the intersection between technology and capital markets. How are things evolving? Ferguson, one of the interesting things about capital markets is there consistently are new financial technologies. Artificial intelligence could allow us to synthesize and communicate massive amounts of data about businesses and the economy, and build much more insightful models of what drives things. But I don't think AI is going to be able to do the things that is really what drives markets. We'll all have the same data, and maybe models will be quicker and available to all of us, but so much of the equity market depends on storytelling and what you believe. Even if you have great analysis, investing at the end of the day is taking a point of view about the future. Having better analytical tools won't help you understand the future better. They'll help you understand the past more quickly. I'm an enthusiast for those new technologies for a variety of reasons, but I've also been around markets long enough to know this is about human beings making judgments. And Barron says, thanks, Roger. And with that, we have come to the end of our reading of Barron's Magazine for October 5th of 2024. This is your reader, Eric, saying be well, be safe, look after each other. Remember our veterans, especially those we've lost recently. Bye for now.